All right, good evening. Welcome to mentorship call for today. We had the last call and it was awesome for everyone that hopped on. Thank you for hopping on. And then I gave assignment after that call. As at now, only 3 persons have responded. So I'll give you some more time. Possibly some persons are busy with work and I understand other activities. So I'll be giving you some time. Just ensure you do the assignment. It's for your own benefit. I want you to be able to spot the mitigation candle and then how to play it. I want you to be able to spot the mitigation candle and then how to play it. So if you have not watched the video, just do yourself a favor by going through the video. You watch it once, you didn't understand, go through it again, and then you'll be able to understand what we try to communicate in that place. Tonight, I'll be talking about institutional candle, or what we call this SM Smart Money Cube. Yeah, that's the name we call it, institutional candle or the Smart Money Cube. Okay, let me put this down. Okay, just 1 minute. I'm trying to give it a good color. That'll be fine. Maybe I should do it test wrapping. All right, maybe something like this will be cool. Okay, institutional candle, smart money play. We're looking at the institutional candle or the smart money cube, SM cube or the smart money cube. Let me recap. I said during the last call we had that mitigation candle or order block, which is also known as order block, is the last bullish candle that captures liquidity, leading to an explosive move in a bearish market. The last bullish candle that captures liquidity in a bullish market, like this is a bullish market. Remember, everything we trade, we don't go against structure. We trade them in line with structure. So what you can see from this now, this is bullish structure. This is an uptrend. You can see a high, you can see a low, you can see another high. Price gave us another high, gave us this low, and price now give us this current high that we have. So by structure, we're expecting higher high to, we're not expecting a higher low to go higher, a higher low to go higher. I'm never looking at the left. If I want to look at the left, I can now tell you what happened at the left, but just following this structure, we should be going higher from here if price comes down. So what is the mitigation candle here? The mitigation candle is that candle that captures liquidity. Let me start from here. If you check this candle, this is a bullish formation. So I said in a bullish formation, it is this bearish candle that captures this liquidity. You can see that liquidity captured there. This bearish is a bullish market. This is an uptrend. Higher high, higher lows, higher high, higher lows, higher high. So this bearish candle that captured this liquidity to the left and then led to this explosive move, breaking this structure. Yes, it broke structure here. Sorry, I like using this one. It broke structure here. If I go to a lower time frame, you see that it broke structure here to the upside. Price will need to come back to it. This is the mitigation candle, this last bearish candle. And I say, how do you trade it? Just look for 50% of it or the open. Play the 50% or the open of it. You can see how price came back to the 50% of that candle, and then we rallied the way to break this high. So this is the mitigation candle in this bullish formation. It is that bearish last bearish candle that cleared liquidity and then led to explosive move. You can see how this candle moved heavily, bought up massively. So this is an institutional candle, sorry, a mitigation candle or an order block. Now we come back to this point, price had to come back. There was also an order block here that price came into. This was the last candle, this bearish candle. All this choppiness started from this week. All this choppiness started from this week, and ended at this week. This was the candle. This was the last candle. But if you go to a weekly time frame, you're going to discover that this is just one candle. Forgetting that it's daily. This is the last week. So this is the candle. Price traded back into it. If I capture 50% now, you say that price came to it at the 50% or the open of this candle. But here it's not too clear, so let's leave that. Let's go and look for another one. Now price kept buying, and you see price came down and went up. Are you not seeing this explosive move? This explosive move is telling you that there is an order block that resulted to this move. There is a mitigation candle. So in a bullish formation, it is this last bearish move, not this bullish move. It is this bearish move. The trade started from this place down and then captured all of this liquidity. All of this liquidity was captured by that candle, and then price moved away. So this is the mitigation candle. So what am I expecting? I'm expecting that price should come back to 50% or the open of this candle. It's going to take time, but this is the explosive move that broke this structure, to the upside. If I go to a lower time frame, it's still going to be the same thing. You are going to find that candle that broke structure resulted to the explosive move, cleared liquidity. So the characteristics of a mitigation candle or an order block is that it will take liquidity to the left and then result to an explosive move. I'm stressing this because for some of you that have watched the video probably and have not understood it and were asking me questions. That's why I needed to spend time to recap this. So we're expecting that price with that keep trading down to 50%, open on the candle, we go higher, or price will come, trade into 50% of that candle, and then we go higher. Whichever way. If price then decide to break this place, it becomes a daily break of structure. I want to believe that is clear. That is what we talk about in the last call. So if you have not watched the video or you have watched it and have not done your assignment, I'm expecting you to do that and submit. I did also say that mitigation candle captures liquidity and it is the beginning of the opposite move. You can see it, the beginning of the opposite move. I also talk about how to play it, that 50% or the open of the candle. If it is, let's say, like a 1 hour candle or a 30 minutes mitigation candle or an order block, and you want to play it, you can either take your entry 50%. Once the stop loss, this is for me. I've said that in the Smart Traders Network that we use 30 pip stop loss maximum. So once the stop loss is not up to 30 pips, I'm going to get in on the trade. The stop loss, you can see it here, 30 pips. You can see this 25 pips. This is daily. So if the stop loss is not up to 30 pips, is within my risk appetite, I can take the trade. So sometimes you're asking me, let's talk about boom 500. If I had played that entry, the mitigation candle on daily, I would have been on that sell right now because the stop loss is around 26 pips. But I was waiting for a lower time frame and all of that, but all the same. So you just know your account size and you know what you can risk. I think I'm going to stop it there. Let's go to what we have today. Today we're talking about smart money play institutional candle or the smart money cube. Please listen very well, pay attention. The video will be dropped in the mentorship group so that you can watch it over and over again. So in a situation of institutional candle, what we call institutional candle is that one candle that goes against the consecutive candles in either a bullish scenario or a bearish scenario. Let me try to explain by drawing a diagram for you. Okay, let's say this is my bullish candle. We're in a bullish market, so let me see this. All right, that's fine. This is a bullish formation. You can see this is a bullish trend, or these are bullish candles. These are bullish candles. These are bullish candles. We're still in a bullish trend. So stay with me, stay with me, stay with me, stay with me, stay with me. Let's go. All right. Okay, let me give you this. Let me use this as an example for you. We have these bullish candles, and then all of a sudden you see something like this. Oh, this is too dark. Can I use this? Green and red. I don't like that color. Okay, maybe something like this. We'll go to the chart so that you see it. What can you find? You have bullish candle moving up. So you expect the market is still buying. All of a sudden, you see this one bearish candle in between the bullish candles. And after that bearish candle, there is a consecutive, or there is a consecutive bullish candles more to the upside. What it then means is that this was buying, price was going higher, and larger volumes were put into this candle to push price down. The real question is why? And then after price pushed down, price rallied up again to the upside. Of course, each of these candles are going to have wicks. Yeah, they are going to have wicks. Then price just moved consecutively to the same direction. Now, I've said while I was talking about liquidity in some of the liquidity videos, I said we have 4 types of liquidity. We have static liquidity, we have dynamic liquidity. I talk about the buy side and the sell side liquidity. You know, equal highs, double tops, and all of that. Though I'm still going to make a video to address them separately in the mentorship team. But now look at this. You see all these bullish candles forming and then one bearish candle. What does that tell you? It simply tells you that this candle is a liquidity candle. It's different from this order block or a mitigation candle. Is different because this candle clears liquidity, but this institutional candle does not clear liquidity, but it is liquidity candle itself. Remember, in Forex, we'll talk about liquidity. We're not talking about maybe where stop losses are taken. Liquidity simply means money. Liquidity means orders, the volume of orders in the market. So liquidity, this candle is a liquidity candle on its own. It means that while prices were going higher, smart money injected larger volumes here to push price down, so that retail traders like you and I, we feel, oh, market wants to start selling. Can you see this big bearish candle? Can you see that big selling candle? Then everybody jumps in. As we jump in, we are expected, okay, we'll just keep going down. Price come, all of a sudden, clears all the stops. And then price goes up in a sporadic, should I call it? Okay, how do I put it now? Yes, price just goes in the opposite direction, in the former direction. So this candle itself is what we call the institutional candle or smart money cube. So how do I define it now? Institutional candle, or also known as smart money cube, is that one bearish candle that goes against the consecutive bullish candle in an uptrend. Let me try to write that. Institutional candle. Let me use this. If you understand what I'm saying, maybe you just drop a fire emoji for me. Let me see. Institutional candle. Let me put also known as, should I use AKA? Also known as, yeah, you know that. Also known as smart money cube. Also known as smart money cube. If you understand what I'm saying, drop a fire emoji, let me see. Also known as smart money cube is that, maybe I should make this capital letter. Okay, is that one candle? Is that one bearish? That what bearish candle goes against? Only two persons are dropping a fire emoji. Does it mean only two persons understand what I'm saying? Against the consecutive, yeah, bullish consecutive bullish candles. Let me put this in up trend. Okay, I think this should be okay. I should put vice versa, right? Okay, let me put this. Our smart money cube is that one bullish candle that goes against the vice versa. Let me do it like this. Okay, I like using black for my lettering. All right, something like this. Okay. All right, so institutional candle is that, or smart money cube is that one bearish candle. As you can see in this case, it goes against the consecutive bullish candles in an uptrend. So if it is in a downtrend, it becomes that one bullish candle now that goes against the consecutive bearish candles in a downtrend. So it's going to be like this. You see a downtrend, price is coming down, and all of a sudden price goes higher, bullish, and then the trend continues its journey. So how do you now trade this? Is the same pattern. You want to take 50% of that candle and wait for price there. So price is going to come to either the 50% or price comes to the open. The same concept. It's smart money concept, so it's the same thing. Price will come to 50% or the open of the candle, and then we can go. So this is an example for a bullish momentum. Maybe I should do this for, all right, let me do this for a bearish momentum. Let me see if I can clone this and just change their colors. You have questions? Let me have them. You have questions? Let me have them. You have questions? Let me have them. Okay, so this is downtrend. Sorry, I was supposed to turn this to red. Yeah. Let me have your questions. Let me have your questions. This is something like this, and then and after that you begin to see another bearish candle. They keep forming after price has given you that fake buy candle that is intended to make you get in the market. They take your orders, hit your stop loss, and then they still go back in your direction. Yes, this is what they do. So maybe I can just take this away. Yes, just take this away. Yeah, I see your question. I see your question. Someone is asking, does it matter in what area of the range this candle appears, say discount or premium? All right, Stena, that's a nice question. I'm going to go to the chart, then I'll show you. Most times, price is supposed to come to a discount region if you want to buy, and then premium if you want to sell. So that's why you need to understand your ranges properly. If you understand your ranges properly, you just play the time frame range. You get it now? Play the time frame range, the range on that time frame. Yeah, so sometimes it can give you something like this for a sell. Price can give you something like this for a sell 50%, or okay, so I should copy this. Control-C. All right. Is that one bullish? Let me pull it bullish now. Sorry, just bear with me. Bullish candle that goes against a consecutive bearish candles in a downtrend. All right, so let me remove the vice versa since I've copied it. So I'll put this here. All right, does it matter whether does time frame? Yeah, time frame, of course, time frame appears. Let's go to the chart so that we'll see. We buy at, that's why I said we don't trade these things in isolation. We trade them in line with structure, in line with structure. So let's go. I didn't prepare for this class to say maybe I want to start searching them out and all of that. They are littered everywhere. They are just there. So we can always find them. So let's go. This is VIX 25. Let's go. Let's look for this. Let's look for these institutional candles in this chart. Let's look for, let's see if we have institutional candle place here or smart money Q place. Remember, I said liquidity is injected in that candle. That's what makes it to hold. It's liquidity that makes anything to hold. Even the fair value gap, your imbalances. If there's no liquidity, the price will not come there. That's why sometimes you see some imbalances, they don't hold because the volume in that place is very small. So price will not want to come there. All right, I can't find anyone here right now. Let's go to Boom 1000. Let's see. 1000. Yes, I think I was showing one of us 1000 today. Was it H4 or daily? Okay, maybe H4. Let's see. Let's see. If we can't get examples there, we'll just let's count the whole asset. We have about over 25 assets here. So okay. All right. Now we know from here that price has been bearish on 1000 on this current time frame. I told us the first thing to identify is your range. So when price was here, this is your range high, this is your range low. Before price came back, this is your range high and range low. So if I carry my Fibonacci retracement tool from here and to this point, you will see that price made sure it went above. This is premium, above 50%. Premium. That was where price sold from. So we're not trading this thing in isolation. Now let's go to the next range. After price gave us this, and price broke this down structure, price gave us this break of structure down, this became my next range. This became my range high and range low after this structure was broken. So if I carry my fib and I put my fib on the current high and current low, You see that price retraced from premium zone, still premium zone. So we don't trade this thing in isolation. Now I remove my fib. When price broke this down structure, here becomes my range, my trading range, the next place I should be looking to trade. So if I want to sell, once price goes above this, I won't be looking for selling opportunities again. What I'll now be looking for is buying opportunities if price break above this, because this is the high, this is the low. I should trade within this place. And since we are bearish, I want to wait for price to come to that zone. Please, guys, just give me 1 minute. Give me 1 minute. All right, sorry guys, I'm back. Okay. So we have this becomes my new range. So if you check, put your fib, you see where price went back from, right? Price went back from here. So this is still premium zone. We are not trading in isolation. I remove this. Now this is my current range. This is the current high, current low. I'm expecting price to keep going down. But what can you find here? Price is moving. Look at my trade: high, low, high, low, in this order: high, low, and price started retracing. So immediately price is retracing. What should I be looking at? I'm looking at this is a smart money cube. This is a smart money cube. Remember, I'm still expecting price to keep going down. So this is smart money cube. I'm expecting price to come here now, and then price can come and do this, can keep coming this way, that to 50%, and then we push lower to take this low liquidity, or we come to the open, and price can just tap the open here and go. So this is an example of an institutional candle. You can see how price was coming down, bearish. You see that one bullish candle there, then there's a consecutive candles that keep coming down. So this is an example on H4. If you find this on H4 daily, what is it called? Price will always react to it. Let's see if we can go to maybe VIX 10 or 25. Okay, we did. Let's try VIX 10. Maybe I'll see more to show you. These things are littered so much on weekly. Most of them, that's where price turns on weekly. You find them there, but I can't seem to get anyone on daily right now. Let me go back to daily. Okay, let's see. All right, what can you find here? I can spot one already. Look at this bullish move. What can you find? There was a sell candle this one sell candle. On the weekly, this is just a single candle. On the weekly, this is just a single candle. So if I take my Fibonacci from the high, from this low to the high, I'm going to discover that that candle is what? Below 50%, because it's still the concept. We must buy at discount and sell at premium. So this was the candle price came to. If you go to weekly, this is just a one move. This is a one move. So you just put it there. This is what we call institutional candle. What it then means, remember, this is daily. If I go to 4 hours, you're going to find a lot of candles here. There was this push down from this week. Price pushed down. And very sure people started selling, because that's why these candles are printed. It's meant to, the candle is liquidity. It's meant to attract people to jump into the market. So people started selling. This candle again, bearish, people started selling. Candle pushed here. Sold to this region before price rejected. When price rejected, I know people will take some profit, and then price went up again and sold down again heavily. So this is daily. People jumped in again. What did you find? There was a push up, and price kept going higher. Price needed to come back to come and react there to close the orders. What did price do? Price came, close the orders beautifully, distributed on 1 hour, and price went higher. So if you find this on lower time frame, price respects them. It's called institutional candle. It's not a mitigation candle or another block because it does not take liquidity. However, there's liquidity in it. There are orders in it that makes price to respect it. Check this. This is 1 hour time frame. Price was coming down in this bearish momentum. Price started buying up. What can you find here? This was a play, and price came, created these tons of liquidity and moved. This was what price came back to react to. If this was on the daily, it would have been better, because this was where the price started and then went down, came down to all of this. This was the low of it. That's where price came, give you a double top, a double bottom rather, and price rallied away. Let's go to crash. I think crash 1000. I saw something there today that played. So let's see. Crash 1000 was bullish, but overall weekly we are bearish. So we're trying to join the bullish momentum. You can see how price have been bullish for a long time. Let's see the daily. Okay. Price gave us high, low, went up, gave us display, and all of that. When price came here, this fair value gap that is here, let me just let me mark it. Let's go to 4 hours. Let's see what is here. Let's see what's there for the 4 hours. I'm going to give you more examples with the currency chart, because I don't seem to get much from here. Okay, fine. This was where that IPA is. I think you can see there was a cube there. This was a smart money cube. This liquidity cube, this liquidity. So if I play this, while you are waiting for price to come down, while you're waiting for price to come down to this side and price didn't come, price can just come, rest here and go back. Price can come, find its path to 50% on the open of this candle, and price will trade away. Then you are wondering, oh, is it at the discount? Why did price play that zone? Price didn't play, it's still at the premium. But if you go to maybe a lower time frame, let's say 15%, you are going to find out that there's a range in that place. That's why price rested there and moved. Let's see if we get the 15% to load. There's a range. There's a range. Okay, 50%. Sorry, 15 minutes. Let's see. This is structure on 15 minutes. A high, a low, a high, a low. And the next we had was this high created, and this was a low. You see that now in the 15 minutes. So if you are playing the 15 minutes range for buy continuation, this would be a good place price should come to rest. Because we are buying, price may not necessarily retrace deep to this place. We are waiting for it. Price may not necessarily retrace to this side, but to this time frame range, this is a low, this is the range high, range low. So price can come, rest on either open or 50%, and we keep going. Now, is it premium or discount zone? Take your fee from here. This is this time frame range. You see that is discount zone. So sometimes you're waiting for price at a zone, price didn't come. Find out if you spot this, what's it called, institutional candle, you spot them, they will hold price. They will hold price. If that smart money cube, they will hold price. So you can just go back, keep back testing, check them out, and then I'm going to make another video to give you more examples using the currency pair so that we can have a better view. All right, let me just go to 5 minutes first. Let me go to 5 minutes or 15 minutes. Yeah, 15 minutes, okay. Oh, this was 15 minutes. Let's see if I can give you, okay. Wow, this was interesting. All right, this is what I'm looking for. Look at this. If I zoom in, price has been bullish because from here, price broke structure here. Price came back to this whole move. Instead, the mitigation candle now, price came, went or broke this structure. Price came back to this imbalance, filled it, broke this structure. Price came back here, and then instead of breaking this structure, it created a cube. It created a cube, an institutional cube, and price went ahead. When price was